Hi there, I'm Lindy Hassa, and in this submodule I'm going to take you through the background to the risk-based approach to anti-money laundering and counter-terrorist financing. Historically, the various AML measures required by the 40 recommendations have not been welcomed with open arms by the financial community. They have been seen as bureaucratic and cumbersome, costly to maintain, and not user-friendly and hostile to good customer relations. In relation to this last point, a particular charge was that banks didn't distinguish between customers. For example, non-risk-based principles would require a financial institution to treat a retired state pensioner in her 70s from an EU member state in the same way as a businessman in his 40s receiving high volumes of funds from a country known for the production of blood diamonds. That is to say, the same identification, KYC, and account monitoring principles would apply to both of these individuals, notwithstanding that clearly, from a risk perspective, their profiles are entirely different. This one-size-fits-all approach was viewed as being exceedingly harsh on the vast majority of customers who actually posed very slight money laundering risks. It also meant that scarce resources were not being applied as effectively as they might be in tackling higher-risk customers and relationships. By spreading the effort over all customers, it was argued that 90% of the effort was effectively being wasted on the 90% of customers who were very unlikely to have any involvement at all with crime or money laundering, with only 10% of the effort being directed at the higher-risk accounts. Wouldn't it be better, so the argument went, if a risk-based system could be introduced which reversed these odds and enabled financial institutions to apply 90% of their available resources towards the 10% of their business, which actually constituted the most serious risk? This would mean less bureaucracy, less paperwork, less form filling, and of course, a more welcoming experience for most customers. Thus was born the risk-based approach, which has now been embodied not only in the FATF 40 recommendations, but also in other standards and in laws and regulations such as the EU Third Money Laundering Directive and the national regulations of all EU member states, the revised Wolfsburg Principles, the revised standards of the Bank for International Settlements, and in the USA Patriot Act as amended. But how do you decide whether a customer is high or low risk from a money laundering perspective? FATF Recommendation 5 refers to 3 criteria: customer, business relationship, or transaction. But in fact, it's possible to draw out a greater number, which we briefly run through here.